Welcome back, guys. And after having discussed exempt benefits, let us now discuss some crucial benefits from an examination perspective. And let's go deeper because this is what will help you answer multiple choice questions. Talking about relocation expenses, I told you, right? My current employer paid for my air travel, paid for transporting the material from Mumbai to Delhi. So a that was a benefit that my employer gave me for by the reason of my employment, and it was for relocating from Mumbai to Delhi. That is a relocation expense. No taxable benefit up to £8,000 if the following conditions are fulfilled. The expenses are incurred in connection with either a totally new employment, a new role with the existing employer, or a change in the location at which the employee's duties are carried out. So, a couple of so three circumstances: a new job like the one I had, or if I was still with my old employer and my old employer was going to charge me, so my old employer was going to send me to another location to build the business there. And in that case, if he pays for relocation, then up to £8,000 the benefit is exempt. And a change in the location at which the employer's duties are carried out: it is necessary to acquire a new residence as commuting would not be viable. If, say, for example, you are moving from within Mumbai, from say Goregaon to, I don't know, Bandra maybe. So commuting is a viable option. Goregaon to Bandra is not such a big deal. In that case, relocation will not apply. The costs met or reimbursed must be qualifying expenses. These include costs of selling the first house, travel and subsistence when looking for a new house, removal expenses, and interest of a bridging loan on a bridging loan while the employee owns both the houses. So, uh, cost of selling the first house, travel and subsistence when looking for a new house. So, you are moving from one apartment to another, talking to the landlord, and you are incurring some travel cost while you are on the house hunt activity. That expense is also allowed. Then subsistence, if you eat food while you are traveling from one location to another while house hunting, that is allowed. Then cost of selling the first house is allowed. And removal expenses, so you pay something to the transporter for packing the goods and removing it from there. And interest on loan on a bridging loan while the employer owns both the houses. So the old house will have to be sold, and there could be a period of time where the old loan is also on and the new loan is also on, so that interest will also be allowed as a deductible expense. The expenditure must be incurred by the end of tax year following the one in which the employment change occurred. So if the employment change occurred in the year 24-25, it must be incurred by the end of the tax year following the one. So if you change the house in 24-25, you can incur this expenditure up to 25-26. Okay, and up to £8,000 on a gross level, it will be exempt, right? If it is above that, then the amount above 8,000 will be taxable. Fair enough? Now, let's talk about medical treatment. An exemption applies for expenditure incurred by employers on recommended medical treatment by a healthcare professional for an employee assessed as unfit for work due to illness or injury after a period of sickness absence of at least 28 days for the purpose of assisting the employee to return to work. Exempt benefit is 500 per employee per tax year. Now imagine a person has suffered a respiratory disorder, and now the doctor has recommended some advanced treatment. And that, see, right now he cannot work, he's unfit to work because of that illness. The doctor has recommended an advanced treatment, and provided he completes that treatment, he will be able to return to work, and the employer pays for that. Then up to £500, the benefit is exempt each year. Okay, then the concept of payrolling benefits. I'll show you what this is. The employer fills out Form P11D with all details of taxable benefits and values of such benefits. The employer then gives this duly filled form to the employee. The employee then includes the value of the taxable benefits in this Form P11D in his tax working, and he pays tax. Now, let me show you what this Form P11D looks like. This is a slightly older version of the form, but it's useful regardless. See, how will I know what is the cost of providing a particular benefit to me? How will I know? see, we are going to see quite a lot of benefits in the next half an hour. So how will I know the value of these benefits? I cannot just sit and guess, ki, okay, my employer gave me this washing machine. This must be the market value. No, the employer has to tell me. And for that, the employer fills this form called Form P11D, wherein he mentions the details of all the benefits that he has given me. So assets transferred, living accommodation, vouchers and credit cards, all of these. Cars and car fuel, make and model, all of these points are in. See, why are make and model required? We'll understand that, we'll understand in the future that the value of a benefit for a petrol driven car, for a diesel car are different. For an electric car, the benefit calculation is different, and all of that has to be provided in one place, which is why, this form has to be given to me by my employer. Okay, only then I'll know what is the value of the benefit that has to be included in my income tax working. Now, let's talk about cash vouchers before we move to the next discussion. See, what are cash vouchers? Cash vouchers are basically like a coupon that is given to you by your employer, and these could be provided to you in different ways. Let's understand how that benefit also works for you. Vouchers provided by the employer. If an employer gives a voucher to his employee, the value of taxable benefit will be the cost to the employer of providing such a benefit. Plutus gives me an Amazon gift voucher of 35,000. Amazon purchased it from an online wholesale vendor for 28,000. What is cost to Plutus? Cost to Plutus is how much did Plutus purchase the gift voucher for? See, when you get these gift vouchers now, don't be under the assumption that your employer purchases that for 1,000 and gives it to you for 1,000. They have deals and contracts with these voucher sellers, and if they are giving you a voucher worth 1,000, to them it costs somewhere around 700 maybe. So that cost is the value of the benefit to you, not the 1,000. Okay, so although Plutus has given me an Amazon gift voucher of 35,000, the company purchased it for 28,000 from the vendor. So that is the value of benefit which has to be included in the form P11D. Now, if the company gives me a credit card and I use the credit card for official purposes, then that is not a taxable benefit. That is not even a benefit. Like Plutus gives me a credit card, I use the credit card to buy study material for ACCA and exam kit for ACCA. I'm using it for official purposes. It's not for my personal use. That is an exempt benefit. On the other hand, that is not even a benefit, forget exempt. But if I use this credit card and I buy Harry Potter books for myself and spend 8,000, that is a personal use. Hence, and if Plutus pays for that 8,000, then that becomes a taxable benefit for me. It is not an exempt benefit. So this is how credit cards and vouchers work. Okay. Now comes a very, very important discussion, which is living up. So, which is basically the value of an accommodation. Okay, now imagine that I'm an employee of Plutus Education and Plutus has given me a house to stay in rent free. See, imagine, had Plutus not given me this house, I would have to pay rent elsewhere. Now, Plutus is giving me a facility to live in a house that they own, and I don't have to pay any rent for that. So basically, it is rent-free accommodation for me. And naturally, any benefit that I receive by the reason of my employment, okay? Uh, any benefit that I receive by the reason of my employment is a taxable benefit or an exempt benefit for me depending upon the value and other factors. Right now, the accommodation benefit that we are going to talk about, think of it as a rent-free accommodation. Okay, when I talk of rent-free accommodation, what I mean is I am staying in the premises given by someone else, but I am not paying rent. So think about it. I'm saving that much cost, and when I'm saving that much cost, that naturally becomes a benefit for me, because had my employer not been in the picture, I would have to pay out of my own pocket. So this rent-free accommodation benefit is as under. Please see, there are two charges. There is your basic charge, which is annual value of property or rent paid by the employer. Now, what is this annual value of property? First of all, this annual value of property is determined by the municipal authorities. It will always be given to you in the question. You don't have to perform any calculation for that. 0.1, or rent paid by the employer, whichever is higher. See, they are very mean people, okay? When they are giving you a benefit, when they are valuing a benefit for you, what they are doing is they will take the higher of the two values. But when you are getting a deduction, they will always take the lower of the two values. Annual value of the property has to be given to you. Rent paid by the employer has to be given to you. Only applicable if the property is rented on behalf of the employee. Okay, this will always be given to you in the paper, never a matter of concern. But if it is an expensive accommodation, that is, the property is purchased by the employer, not rented, and the property cost is in excess of £75,000. In that case, the benefit is cost of accommodation minus 75,000 into the official rate of interest, or the ORI, which is 2.25%. Okay, we'll do questions for you to understand how this works. Also remember, what is cost? Cost is the purchase price of the property when it was first purchased. Okay, it is purchase price of the property when it was first purchased plus the cost of capital improvements made before the start of the tax year. Okay, so I might have purchased the property for 73,000, but I have made improvements to the property worth 18,000. So 73 plus 18 is how much? 91,000. So that will become the cost of the property. Cost minus 75,000 into ORI gives me my additional charge for expensive accommodation. Okay, now we'll do questions to understand this, don't worry. But if property is owned by the employer for more than 6 years before it is provided to the employee, use market value of the property when first provided, not the purchase price. Irrespective of market value, the additional charge will apply to a property where the original cost plus improvements completed prior to the start of the tax year exceeds 75,000. 2.25% is the rate. This will be given to you, but pay attention to the flow chart that I am discussing, okay? Come here. Additional charge applicable only if property is purchased, not applicable for a rented property. Okay. If it is a rented property, this will not come into picture. Ask yourself the question, is cost greater than 75,000? But what is cost? Original purchase price, or I would say original purchase cost plus cost of improvements completed prior to the start of the tax year. Okay, so if I constructed a balcony, or I put up a chimney, or I did any of this centralized heating or something on those capital improvements, okay, completed prior to the start of the year, that is the total cost. Is this greater than 75,000? If the answer is no, no additional charge. If the answer to this question is the cost greater than 75,000, if the answer to this question is yes, then additional charge is cost of accommodation minus 75,000 into ORI, that is the official rate of interest. Now ask yourself the question, is the property owned for more than 6 years before providing it to the employee? If the answer is no, then use original cost. If the answer is yes, use market value in place of purchase price or original cost. So how does it flow? Okay, let's observe the step by step flow once again. The steps are very important. Question 1, is the property owned or is it rented? If it is rented, doesn't apply. If it is purchased property, then it applies. Then ask the question, is cost greater than 75,000 or not? What is cost? Original purchase cost plus the cost of additional improvements made before the start of the tax year. If this value is greater than 75,000, if the answer is no, then no additional charge. If the answer it is greater than 75,000, then the additional charge is cost of accommodation minus 75,000 into official rate of interest. Step 1. Ask yourself one more question. Is the property owned for more than 6 years before it was provided to the employee? If the answer is no, use original cost. If the answer is yes, then use market value in place of original cost. And this has to be market value when first provided to the employee. Okay, now if the accommodation is a job related accommodation, okay, to qualify for then no benefit arises when it is a job related accommodation. To qualify as a JRA, the property must be provided where it is necessary for proper performance of the employee's duties. For example, a caretaker. I was watching this series called Downton Abbey. It was about this aristocratic family in London, in England, basically. So, they have servants and servant quarters, and those servants stay on those quarters only to help the family and run the show. that is job related accommodation. For better performance of employees' duties or for that type of employment, it is customary for employers to provide living accommodation. Think about a warden in a hostel. That person has to stay on the premises, otherwise, his job will not be done, right? And it is customary to do it that way. Then again, it is a job related accommodation. And where there is a special threat to the employee's security and the employee resides in the accommodation as a part of special security arrangements like 10 Downing Street, which is the official residence of the Prime Minister, or the White House, which is an official residence of the President of the United States. So these are again job related accommodations. And a director can claim one of the first two exemptions if the director has no material interest in the company and is a full-time working director, or the company is a non-profit making organization. Otherwise, the benefit will not come to him in the first two cases. Now, JRA is not tested so much because there isn't too much of a calculation there. But yes, the additional charge for expensive accommodation will be an important consideration for MCQs also. And we'll be doing questions on this for you to understand better. But before we get down to solving questions, I wanted to discuss the living accommodation expenses. Now, living accommodation expenses would include charges that you pay for electricity, heating, lighting, certain, other services that are provided in the house, like cleaning the premises or cleaning the chimneys or, cleaning the solar panels. Like, if you have a solar panel installed for electricity supply and you have to clean that every week, then naturally, you will have to make sure that those are also considered as taxable benefits, because normally you have to pay for all of these things, but you are getting it because of your connection with the employer, or you are getting a maid, you are getting cleaning services, you are getting housekeeping, you are getting all of this. So these are living accommodation expenses. Okay. So if it is not a JRA, if it is not a job related accommodation, then expenses in connection with living accommodation, the value of the taxable benefit is cost to the employer. If certain assets are given to you for use, for example, in my house, my employer has given me a refrigerator for use, a geyser, a microwave. Now, he has not gifted it to me, he has not transferred it to me, but while I stay in that house, I use all of these assets basically. So, there we'll have to apply the 20% rule. Now, what is this 20% rule? Where the ownership of the asset is retained by the employer, but the employee has private use of the asset, the taxable benefit is 20% into open market value when first made available. Okay, 20% into open market value when first made available, which is usually the cost. Or where the employer rents the asset made available to the employee instead of buying it, the employee is taxed on the higher of the rent paid by the employer, or 20% rule. So my employer has not purchased the refrigerator, but he has taken the refrigerator on rent and he has installed it in the house in which I am staying. So the value of the benefit will be higher of the rent that he paid, or the 20% of the cost of the open market value when first made available. The higher of the two will be the taxable benefit. Provision of one mobile phone is an exempt benefit. Okay. So if assets are provided by the employer to the employee for use in his premises, then we apply the 20% rule. Okay. And what is the 20% rule? Take the market value of the asset when first provided, which is usually the cost of that asset, multiply that by 20%, time apportion that if necessary, and that is the value of the benefit. This is what happens when it is not a job related accommodation. On the other hand, if it is a job related accommodation, then total benefits are limited to the 10% rule. Okay, what is the 10% rule? And this is total benefits. What do I mean by total benefits? Basically, living accommodation expenses and use of assets combined together is subject to 10% rule. The 10% JRA limit applies to the following types of expenses: heating, lighting, cleaning, repair, maintenance, or decorating the premises, and the use of furniture or goods for normal domestic occupation. Okay, now cost to the employer of providing these benefits is 12,000. Employees' net earnings are 1 lakh and 10% of that is 10,000. Although cost to the employer is 12,000, benefit is restricted to 10,000. This is the 10% rule. The total accommodation benefits taxed on an employee for JRA is limited to 10% of net earnings. And what are net earnings? Net earnings are basically employment income, including all the assessable benefits other than the living accommodation ancillary benefits. Okay, so if it is not a JRA, then living accommodation expenses are taxed at cost to the employer. Use of assets is taxed at 20% rule. What is 20% rule? Take 20% of the value of the market value or a fair, I shouldn't use the word fair value, use the word open market value on the date when it was first made available. If it is rented, then rent paid or 20% rule, whichever is higher. But if it is a JRA, then the benefit with respect to assets and living accommodation is not taxed separately. The amount of benefit is restricted to 10% of the 10% rule, 10% of the net earnings. And what are net earnings? Basically, employment income, including all accessible benefits other than the living accommodation ancillary benefits. That is how the job related accommodation rule works. Now, let's have a look at one question. Kauri, a director of X Limited, lives in a furnished company flat which cost the company 1,11,000 pounds on 1st of June 19. He occupied the property from 15th of June 19. The accommodation is not job related. The annual value of the flat is 2500 and Kauri pays X Limited rent of 150 per month. Furniture was worth 6,000 pounds in June 2008. The company pays 2,000 for running cost of the flat and 1,500 in council tax. Now, provision of living accommodation has two elements to it. There is a basic charge. How is that basic charge calculated? Higher of annual value of property or rent paid by the employer. If you observe, the annual value of the property is given in the question 2500. Employer has purchased this flat. So you cannot have anything here rent paid by the employer. It is zero. Higher of the two is basic charge. And second thing is additional charge for expensive accommodation. Additional charge for expensive accommodation applies when cost is greater than 75,000. Okay. And what is cost? Original cost when purchased plus any capital improvements made to the property before the start of the tax year. So that is 1,11,000. Okay. 1,11,000 plus something. If that is not there, then 1,11,000 minus 75,000 into 2.25% comes to 810. So the living accommodation benefit value is 3310, 2500 plus 810. But Kauri pays a rent of 150 a month. So you will have to subtract that 150 a month. But pay attention. Why? Because this calculation would be, it would be unfair to do the calculation this way. Why? Because Corey occupied the flat from 1st of June 19. Okay. So you cannot subtract 150 into 12. You will have to subtract 150 into 10, which is minus 150 into 10. The value of the benefit will be 1810. That will be the total taxable benefit. Okay. Why 150 into 10? He occupied, okay, from 15th of June 2019. So it's not even 10 months. It's July, August, September, October, November, December, Jan, Feb, March. So 9 months and a half. So ideally, when I subtract rent paid by the employer, it has to be 9.5 months. Okay. He occupied the flat from 15th of June 2019. So ideally, I should subtract 9.5, 1425, and the value of the taxable benefit is 1885. Okay, that is the value of the living accommodation benefit. Then furniture was worth 6,000. Furniture is an asset provided by the employer. This is not a JRA. Okay, this is not a job related accommodation. So the value of the taxable benefit here will be open market value of the asset when provided into 20%. So 6,000 into 20%, 1,200. But that's not all. Furniture was worth 6,000 in June 18. Okay. And see, he moved into the flat on first, he occupied the property from 15th of June. Now tell me, if he occupied the property from 15th of June, then again, this has to be done. The actual value of the benefit here would be taxable benefit will be 1,200 into 9.5 by 12. Why 9.5 by 12? Because it was only provided for that much duration, right? And the company pays 2000 for running cost of the flat and 1500 in council tax. This I'm taking as cost to the employer, which is 3500. See, in this case, it's again, you will have to be careful in terms of valuing the benefit. If the property was occupied only for 9.5 months, then the value of the benefit should also be time apportioned. So, value of benefit, how much is that? 3500 into 9.5 by 12, which is 2771. This will be the value of your taxable benefit. Pay attention. The asset was not given for the entire year. See, because furniture can be given to him only after he enters the flat, right? That cannot be given to him before he enters the flat. So naturally, you will have to time a portion, and 1885, 2771, and 950. These are the total taxable benefits that you can ascribe to this particular employee in this situation. Okay, so it's important for you now to learn how the benefit is calculated and apply the impact accordingly. There will be, there are a couple of more benefits that we need to study. So we'll spend time on that now. Okay, but living accommodation expense and the living accommodation benefit both are very important, and you can expect a multiple choice question from this part.